Thank you for listening to Lone Star Community Radio. This program was broadcasted and recorded live from the LSCR studios in downtown Conroe, Texas. Lone Star Community Radio is supported by listeners like you. Donate and sponsor today. For more information on getting involved with Lone Star Community Radio, contact us at lscrstudios@gmail.com or visit us online at www.irlonestar.com.
Welcome to Veterans Air, the Veterans Hour. I am your host, Douglas B. Veterans Hour is your source for news, talk, and uncensored commentary here on the Lone Star Community Radio. You can listen to us the first Tuesday of every month at 1 p.m. and also on our website, VeteransAir.us, and on Conroe's very own FM 106.1 and 104.5. You can listen to us on Facebook Live, YouTube, and wherever you get your fine podcasts. As always, a little housekeeping before we get started. You can contact Veterans Air through our website at www.veteransair.us. Leave us a message, leave us an email, or better yet, text us in the studio on our Google phone, 936-344-3083. Got a great show for you. Title of the show is Tax Advice for Veterans, but this is applicable to everybody that pays tax. In the studio with us today, we have Stephen Zogal from Spring Tax Advisors. Hey, Stephen, how you doing?
Hey, how you doing?
Been about a year since you've been here. Yes. Why don't you tell the studio a little bit about yourself? Stephen is a veteran. Well, he's Air Force, so that's almost like
it's
being a veteran. It's
better than Coast Guard.
That's true. That's true. That's true.
So, yeah, I'm an enrolled agent. For those of you who don't know, that's a license that's issued by the Department of the Treasury. And so I can work in all 50 states. It's not a state thing like a CPA where it's issued by the state. This is a federal. So I specialize in taxation. And I've been in the field pretty much since 2009. I've owned 2 accounting firms, bought and sold, and I think this is my third and final one. It's kind of my, Hail Mary. I think we'll franchise it. But I have great clients. I have a lot of great, wonderful clients who come out and see me, and without them, I wouldn't be anybody. So, but I want to go over a few things, if you're ready.
Yeah, yes and no. First off, I want to say that I've known Stephen for about 4 years now.
Yeah.
Been doing my taxes, referred friends, family, other veterans to him. He's really, really good. And hopefully this year he can make it so I'm not going to pay any taxes. That'd be nice.
I got a few tips that everybody loves tax-free money, right?
Everybody loves tax-free. Taxes are a certainty in life. You have to pay taxes. If you want the public services that you use, you have to pay taxes.
Yeah.
I think people get upset when they see their tax dollars squandered.
I think what gets the most people upset is that we have this big, thick tax code, and you wouldn't understand it unless you studied it. And unless you're willing to sit there and read 67,000 pages of tax law, you're not going to understand it. And so it makes it inaccessible to a lot of majority of folks that are not aware of the laws, right?
Well, isn't that what we get to pay you for?
Well, yes, but shouldn't it be more accessible and understandable? So I think that's where a lot of people get upset at. So I'm going to clear some air with a few tips and tricks of the trade.
Well, first off, tell the people how they can get hold of you.
You can reach me at 844-335-0055, or you can go out to my website, www.springtaxadvisors.com. And as always, you'll find my email and information out there, and you can just send me an email or contact us web form, or you can give us a call. Either one works.
And we've talked before to get you back on the show here, and want to let everyone know that I'm going to do to Stephen the same thing that I used to do my dad, who was a CPA. I'm just going to show up with a big shopping bag full of receipts and drop them on your desk and tell you how much money I need back. No, seriously, he's very, very good. He's helped me out a number of times because I don't keep records. They just throw them away.
If you do that, I'm going to make sure that the government pays you back with monopoly money. So.
As long as I don't go broke paying my penalties and fees, I'm fine. So, Spring Tax Assessors, your office is on Sawdust, right?
It's now on Sawdust, yeah.
And that's
although we keep in the office location in the Woodlands open as well. So.
Well, Sawdust is in the Woodlands.
Spring, West Spring.
Oh.
I mean, who's really counting? I mean, might as well say Greater Houston at this point.
That's true. Hey, Dick, can you put his contact information up on the screen when you finish the show or in the show notes for me? I'd appreciate it.
Yep.
All right. Well, let's get to it. You're very prepared, Air Force. You gave me questions and answers. I like that.
Yeah, I gave you 4 pages. I was going to do 5, but I wasn't sure if we would have time for that.
No, this is only an hour show.
Yeah.
So it takes a while. All right. Ladies and gentlemen, without further ado, Stephen Zogal, who's going to tell you about some changes and tips for this filing season on April 15th. I know it's only January. I realize that. But if you wait to the last minute like I do, poor Stephen's going to get more gray hair than he has now. So, prepare.
I think this gray hair right here that's coming in, that patch, I think that's yours. So.
Well, wait till you see what I have for you this year, my friend.
All right. Well, I mean, you like tax-free money, right?
I do like tax-free money.
I mean, I love tax-free money. I don't want to pay any more tax than what I have to.
Mm-hmm.
I mean, that's probably why I got into this industry, right? I wanted to know everything that there was to know, so that when Uncle Sam came knocking, I said, "No, I already gave you my $1."
Like I said, I don't mind paying tax because we have to pay tax if we're going to use community services.
Right, but you don't want to pay tax
that's
where
right.
you don't have to.
That's right.
You want to pay your fair share.
That's right. I don't want to pay somebody else's.
The tax laws it's applicable across the whole U.S. It's a federal statute, right? Title 26. So it goes to every single taxpayer. There's not a single one exempt from that, except, we're not going to.
There's 317 million Americans.
But you heard about presidential pardons, right?
Did he pardon himself from paying tax?
I don't think it went towards. I think he still paid the tax, right?
I mean, I know he pardoned.
But it was like 10 years, yeah.
Oh yeah, from 2014 to present, from anything that he did or might have done.
So, but yeah. Anyways, one of the things that I always bark on, one tip that I have to say is, you have a home, right? I have a home. A lot of people have a home. But whenever they go to sell the home, sometimes they forget about this one rule. And it's under Publication 523, okay? Section 121 exclusion, which is the home exclusion capital gain rule. Are you familiar with that?
Yes. The way I understand it is if I sell my home and I buy another home, I can take everything that I use from the sale into that home, put it into the home for renovation or whatnot, and I don't have to pay tax on that pot of money.
No, that's not exactly true.
Damn.
So, no, I'm talking about a different, a whole different slate, okay? So what it is, okay, is I can potentially have $500,000 of tax-free income. Now, you may ask me, how's this so? Well, it's possible underneath this exclusion, which basically is if that house is my primary house, right?
Mm-hmm.
And I lived in it for 2 out of 5 years. I can say, okay, well, if I'm married filing joint, it's really $250,000 a pop for each of you, right? Your wife and yourself, or $250,000 if you're single, that you can exclude from capital gains. So it's not taxable from capital gains. If you turn around and sell it, and that was your primary home for 2 out of 5 years, and you meet those tests, it's not taxable. And so a lot of people use it in the real estate industry. A lot of people don't know this, but you can turn around and a lot of people use this as a strategy that do know of it, is that they'll have a house, they'll live in it, renovate it for 2 out of 5 years. Then they'll turn around, sell it, have that meet the exclusion rule. Then they will take those capital gains, go back, that they didn't pay any tax on, go back, they go buy another house, right? But the key here is that it has to be your primary. Has to be. Otherwise, it doesn't qualify. So that's one of a tax-free strategy that you can do. Now, granted, you can only use this exclusion once every 2 years, meaning if you go around, you sell your house in 2024, okay, you're not going to be able to use this exclusion again for another 2 years.
Well, that makes sense. Well, let me put you on the spot. What is capital gains tax?
Capital gains tax is a tax on sale of real property or intangible property, right? So, for example, you have a baseball card, you spent $10 on it. Later down the road, 10 years later, it's worth $100,000. Well, now, whenever you go around, you turn around and sell it, there's a capital gains tax. Since it's 10 years, it would be long term. That would be subjected to a 15% tax.
50%?
15%.
Oh, 15%.
Yeah, 15.
I'm going to go 50%. Right. I didn't save enough
money. 20% if you hit a certain bracket. But that's what capital gains is. And capital gains tax applies to the sale of property. So if you can get that exclusion on your primary home, why wouldn't you do it? And some people, they may not have the right tax advisor. They forget about that exclusion. So they end up paying capital gains tax on their primary house that they sold, that they was their main residence, just because the advisor was unaware of it. So it's a very good rule, and it's a very good strategy. I mean, I would use it if I was to ever sell my home. I'm not saying I would in this market, but
if I ever sell out,
right, have that exclusion. You're talking about 15% on $500,000. Why wouldn't you do it?
That's right. That's a lot
to exclude. So that's a very good rule if you're ever doing it. Now, have you ever heard of the Augusta rule? I
have not heard of any of these rules.
Well,
and I think I'm an average taxpayer.
I mean, with your father being a CPA, you would think it'd be a little bit more.
Well, like I said, I would show up with a bag of receipts and put it on his desk and tell him, I need $3,000 back this year, Dad. And then close the door because he'd start yelling.
Well, if you ever want a tax-free income that's going to cover your next cruise to Alaska, right? Which, by the way, I'm going in April.
You suck.
I know. But it's going to be great. I'll send you pictures.
Thank you. I appreciate that. Just rub my face in. Here you go.
But the Augusta rule, it's under the IRS section 280A, okay, subsection G. And what it does...
He talks like a tax guy.
And what it does is if you want to rent out your main home or any home that you have, right, it allows you to exclude 14 days of rent, non-taxable.
I was reading that and going, you know what? Those people that have nice homes and they're going on a cruise for 2 weeks, put on Airbnb or something like that. Right. There you go.
It pays for your vacation.
That's right.
Tax-free income. Right. You like a free vacation, right?
I would love a free vacation.
I like free vacations.
Free vacation would be nice.
So, every year, 14 days, put it on Airbnb, rent it out. That pays for your family vacation, right? You don't have to report to the IRS. Now, of course, if it goes over the 14 days, then stop right where you are because you're not going to meet that exclusion. If you go over that, of course, you have to add a rental schedule, Schedule E, and then you have to show the income and then the deductions, the expenses up against it so that you get down to what the net taxable income on what you brought in is. So, it's a very helpful rule. Once again, tax-free.
If I had a nice house, I could see that.
Tax-free, why wouldn't you do it?
Why wouldn't you do it? It's legal.
It is legal. So, that's the best part. And I'm sure, just like you, this even applies to you, this next item. Have you ever heard of the Cohan rule?
No.
All right. Well, for those of you who don't know who Mr. Cohan was, it was a court case. He went up against the IRS commissioner, and it was basically where, he didn't have any of his records. He couldn't say what his income was or what his expenses were up against that income.
You're right. This is me.
So, yeah, drop that shoebox off, right? So they estimated, right? Because you still have to file a tax return. You made income. You don't want to go underneath that tax fraud and evasion category. File that tax return. It's the law. You have to. If you have a certain amount of income, right? You have to report it. So, anyways, it came down that the tax court said, okay, well, he's allowed to do that, right? But that doesn't meet substantiation. So be careful with this one, right? Because if you use the Cohan rule to prepare your taxes, where you make estimates, it doesn't necessarily mean that it meets substantiation.
Well, what do you mean by substantiation?
I mean like a receipt, a W-2 form, or even though that the IRS has that information, right? Or expenses where you have an invoice for. So that's hard evidence. That's substantiation. So while you can use the Cohan rule to estimate out what your most likely your taxes are, it doesn't necessarily meet that substantiation rule, and so it could be disallowed, or the tax courts, if it ever goes up there, come back and say, okay, well, we're going to adjust this because we think that this amount is actually XXX.
Well, let me ask you this question. Would a credit card statement from, say, Home Depot, you don't have the receipts, but you paid it by credit card, would that meet a substantiation rule?
Let me ask you this. Are you able to get Mountain Dew at Home Depot?
Yes.
Okay. So would that be a tax deduction?
No.
No. So receipts, the IRS, they don't like taking bank statements of credit card statements for that reason. They like the hard receipts that show what you actually purchased, right? Now, if you were a vendor that was selling Cokes on the side of the road, and you was buying your Cokes from Home Depot, then yeah, that could possibly be a deduction.
Well, I might need that Mountain Dew.
But I mean, it's context, right? Context matters. But no, the IRS doesn't necessarily like taking the bank statements or the credit card statements. You could probably get into a room with the auditor and say, okay, well, we think that we have this much. You think that, you have this much. Let's meet in the middle, right?
Well, with this
you
rule,
can negotiate, but
would this rule up your chances of being audited if you use this rule?
Oh, absolutely. So, I mean, think about this. Whenever you use an estimate, do you normally use numbers at the end with the 0?
Mm-hmm.
So it's going to stick out like a sore thumb. So yes, it throws up a red flag. Also, if you're a preparer out there and you're going to use this rule, please use the disclosure statement letting the IRS know that taxpayer estimates were used to avoid the accuracy related penalties under the IRC 6662. Okay.
Now, if we use this rule,
Mm-hmm.
and you prepared my taxes, and I get audited, are you going with your client to the audit?
Absolutely, if they pay me for it. If I'm engaged with the client and they get audited, then yes.
Yes.
I
Stop begging your hands.
I do do IRS representation. So, but what I will have you do if you ever get pulled up with an audit, we use this rule to prepare your taxes, is, hey, you're going to be digging around looking for those substantiations.
I'm gonna tell him I didn't prepare him. You did. Go arrest him. He did it.
Mm-hmm.
I just signed what he told me to sign.
Mm-hmm. But you ultimately the taxpayer is responsible for the statements that they made on the return. So now I always go over with this with my clients if I ever get into this case, and sometimes I do. Sometimes I get a business owner who they have a Schedule C, they're self-employed, but they don't have all their records, and they don't have enough time to put them all together either. We'll go find them, or it got lost in the trash somewhere.
Keep your receipts, people.
Yes, keep your receipts. It's very important because that's the difference between whenever we get pulled up for an audit, if it's going to be a quick one where we can close it out very fast, or it's going to be a long, drawn-out process.
Well, since you brought up business, let's talk about businesses.
Mm-hmm.
I know from my father that if you're using your personal auto for business,
Mm-hmm.
you got to keep the mileage records. But that advice was, 94, 93 earlier.
It's still the same to this day. If you're self-employed, you can use the mileage, standard mileage, or you can use actual expense. I actually have that in here for those of you who are going to sit there and read this document.
I will post the PDF. I will post the PDF in the show links down at the bottom, so it'll be there. All right, so let's start from the beginning. What is a business? Is it S corp, C corps, LLCs? What is it?
Okay, first off, there's a lot of confusion that goes around, especially on TikTok and Instagram, Facebook, with people giving bad advice. And they're not credentialed, or they haven't been in this industry. They just take something they see off online and then they post a video about it, and nothing could be further from the truth. So I'm going to clear the air.
It was on YouTube. It has to be true.
Google said this. So let me clear the air here. You can either be in a business, self-employed, which is Schedule C. You can be an LLC, But an LLC, which, by the way, only breaks out for it to be treated as its own entity. So it's a liability issue, right? If you have an LLC and you're doing business as an LLC, well then, in a lawsuit, because it's treated as its own entity, only the LLC can be sued. So it does exactly that. It helps protect your assets, right? It does nothing else. Nothing else.
Well, what I tell people, that to form the LLC, and here's why, the Limited Liability Corporation, here's why you would do that. So let's say, for the sake of argument, you have a landscaping company, and you got your landscaping company, you're doing good, you're making money, doing everything that you're supposed to, and all of a sudden an accident happens, and you drive your skid steer through the front of the house. Mm-hmm. Now, that homeowner's going to sue.
Oh, absolutely. And they have every right to.
That's right. And they're going to sue your company, LLC.
Correct.
So your private assets can't be leaned against because the LLC is a legal entity.
And that is absolutely correct, right? So a lot of times, you don't exactly need an LLC to conduct business. It's not a requirement, but it's a great idea to form. Why? Because of reasons of liability. You want your assets to be protected. So, in business, you can either be self-employed, you can be a self-employed LLC, you can be an S Corp LLC, you can be a corporation LLC. I've seen those. Without the INC, yeah, those get interesting. And you can be in partnership, a PLLC. So you don't necessarily have to have an LLC to conduct business, but it's a great idea. Okay.
You can conduct business with a simple DBA.
And even less than a DBA.
So. Doing it right now.
Mm-hmm. So, and by the way, for those of you who don't know, DBA is doing business as. So, for example, my company is Accounting Wise LLC, but I have a DBA, Spring Tax Advisors.
You got to speak up a little bit.
So what a DBA does is it allows me to operate underneath an assumed name rather than my legal name. All right?
A lot of businesses do that. East Meets West Production, who's actually paying me my salary to sit here and do this. The corporation is East Meets West Productions, Inc.
Right.
They have a DBA for EMW Productions. It's just it's a way to differentiate, but still be the same legal entity.
Correct. Absolutely. So that's what an LLC is, and how you can operate businesses underneath it. Now, here's some of the things that you can do with businesses. Right. Initially, whenever you start out, you want to start out as self-employed. Maybe LLC depending on the type of activity that you're doing, rather than if you want to protect those assets or not. Now, once you reach a certain limit, usually that limit for me is about a $60,000 bottom line. What is a bottom line? A bottom line is once you have your gross income, all the expenses pinned up against it, and then you get your bottom, what you have left. That is what a bottom line is. So when you have about a $60,000 bottom line, other tax preparers, they may have different other limits, but mine really is about 60. You want to turn yourself into an S Corp. Because, and here's the reason why, S Corps are not subjected to self-employment tax. So all the requirement is for an S Corp is that you issue yourself payroll, the shareholders' payroll, and it has to be reasonable compensation. Now, reasonable compensation is a bit of a gray area. There's a lot in that subject. It's too much to get into this show, so I apologize. But typically, it's about 33% of your gross. It's what I would consider reasonable compensation. Right. So if I have $100,000, I should be paying myself $33,000. But what that means is that the other $66,000 that I leave there at the bottom line on the S corp isn't subjected to the self-employment tax that you would have had if you had it on a Schedule C. So,
I'm shaking my head yes because I'm agreeing with all this. And it goes along with what I learned.
It saves money. Saves money on your tax, I should say.
Lisa, Renee, are you listening to this? Is this not exactly what I told you that you need to be doing? Pay attention. Yeah, I got another client for you.
So, one of the changes that is coming through, and it's a big change in the area of assets for a business, is depreciation. What was it this year? Bonus depreciation is what I'm talking about. And do you know what depreciation is?
I know what depreciation is, but tell the listeners.
Depreciation is the expense that you can write off up against your asset. So, in layman terms, if I have an asset worth $10,000 and I'm able to take, let's say, $3,000 of depreciation expense and write it off against my income.
And
Capitalization policies.
And that happens every year, but there's a different percentage that you can take as it depreciates.
Correct.
And this depreciation, this is usually used against a capital asset.
Correct.
You can't depreciate your shovel.
I mean, you could, but why would you want to? And I'm going to get to that in a second. That's another wool, right? Because it's still an asset. It's still it's a tangible. It's something that you can touch. It's something that you can resell, correct?
No, that's true.
So, but we'll get to that here in a second, okay? Bonus depreciation. The greatest change is that this year in 2024, it was 60% bonus depreciation. So if you're going to buy an asset, make sure to talk to your accountant and make sure to get that in before the end of 2024. Time's running out. But next year, it's going down to 40%.
That's a big drop.
It's a substantial drop. Now, hopefully with this Trump administration, tax law changes every year. Bonus depreciation was something that got placed into effect underneath the TCJA Act, Tax Cuts and Jobs Act, right? And that was a Trump administration thing back in 2017.
Yeah, and it's ending unless he gets to be able to renew it.
Exactly. So hopefully he gets in there and renews this thing. That could help a lot of businesses out. And in turn, all that capital is going to shuffle down to the employees.
So all good listeners, I hope you've made the connection here that if you're running a business, that you need somebody like Steven to advise you to when you go to make these purchases.
Absolutely. Always talk to your accountant.
Dick, where am I at? 35 minutes left? Good. Okay.
Now, always talk to your accountant, your advisor, before you make any moves, right? Because it doesn't apply to all situations. I'm giving you really the shorthand, right? Because tax law, it's deep. You can talk for hours and hours and hours on it and still not be down to the bottom of it. So always talk to your advisor about your specific situation, because each of these, of course, there's a certain rules to it that do apply. But in general, it's going down. Now, So that's changes coming. Hopefully the Trump administration gets in there and they say, okay, we're going to renew it, and it goes through Congress and everything. I got my fingers crossed. So the next thing is that I'd like to talk about is the shovel. Now, let's say I owned a landscaping company. I want to go out and purchase 10 shovels because I need to dig a hole. Right? And I'm not going to say I'm going to throw you into it, Doug, but...
Like I said, you're the tax preparer. You're on the line for this. I'm going to say, I just don't know IRS. I just paid him.
So, those 10 shovels, right? It's underneath the $2,500 mark. That is known as the de minimis safe harbor election. And it's a long word for something that can simply just be said that if your item is underneath $2,500, then you do not need to capitalize it, and so therefore there is no depreciation expense. You just throw it onto your P&L, which is your profit and loss statement as an expense, and you write that sucker off.
See, that's what that. As you know, I do technology.
Mm-hmm. Yeah,
and that's what I tell the clients. Say, look, you need new computers, and you have to go out and buy those computers, but those computers can come off your tax. Yeah. No, it can't. Yes, it can come off your tax. It's an expense.
Mm-hmm. And it is if it's underneath the $2,500. If not, it has to go onto the asset schedule, and then taking depreciation on to write it off. So that's that wonderful safe harbor election, and the IRS, they came together on that so that it lowers down paperwork, which I'm all for, right? We got enough paperwork as it is already from the IRS, thousands of forms. Why do we need to add more to the chaos? So, the standard mileage versus actual
let's talk about mileage, because a lot of people don't know this or take this mileage that they can. And a lot of people, if they know about it, they're doing it wrong. It's not, you can't deduct mileage from your house to your place of work.
Well, that's actually not correct.
We need a break? We need a break.
Okay, I'm going to elaborate more on that when
ladies and gentlemen, we're going to take a short break here for important messages, and then we'll come back and we're going to finish talking to Stephen about taxes in 2024. This is Veterans Air. We'll be right back after these messages.
Medicare can be confusing, but it doesn't have to be. My name is Andrea Corpening, and I am an agent authorized to offer AARP Medicare plans from UnitedHealthcare Insurance Company. I can guide my clients through understanding Medicare coverage options and help them discover what may make AARP Medicare plans from UnitedHealthcare a great choice. I can be reached at 281-773-6239. That's Andrea Corpening at 281-773-6239. I can help those find a plan with confidence.
Welcome back to Veterans Air, the Veterans Hour. We're talking with Stephen Zogal from Spring Tax. Spring Tax what?
Spring Tax Advisors.
Spring Tax Advisors. And he is advising us, letting us know about changes to the 2024 tax code and how you can save some money. So before the break, we were going to talk about standard deduction for mileage.
Yes, sir. Yeah. So, you said something interesting before. You want to say it again?
About what you can take mileage for?
Yes.
That you can't declare mileage from your house to your place of business.
But in some cases, that's not true. What if your house is actually your place of business?
Well, then you don't have any mileage.
That's not true either. In some situations.
I'm getting this impression that I'm going to have to start tracking my mileage.
So in some situations, let's say you have your place of business. Let's say you're the AC guy. Okay. You keep all your tools and equipment inside the garage. You have a little small home office with its own separate door and its own little place and its furniture and its computer so that you can send out invoices. You don't have commercial property. That is your business. Your home is your place of business. That's your primary place that you conduct your business. You don't go nowhere else. If he was to leave and go from that spot to a client,
That
service
is,
him.
yes.
Right.
I
So
was
in
speaking-
those,
I was speaking in the traditional sense where you leave your house and you go to an office someplace to work.
okay, yeah. No, you can't leave your home and go from your home to your place, your primary place of business, and count that as mileage. Sorry, folks, it don't work that way.
It'd be nice if it did.
It would be nice.
With all those people on, a 2-hour commute and go, hey, guess what?
At the same token, I wish we could write off our food and our grocery bill. Hey, I need that energy to work. If I'm not alive, I can't produce income. But
That was my theory about the diet, about the Mountain Dew, just so you know.
I mean, I wish that was true, but it's not. Unfortunately, now hopefully maybe Trump does something about that too. We'll see. But gosh, that would be nice. But you can do, whenever you're self-employed, right? You're filing on a Schedule C. You're not a partnership. You're not an S corporation. You're not a corporation. You can do actually the standard mileage rate, or you can take actual expense. Now, every year you want to look at this. Now, that is because you could be leaving money on the table. If your standard mileage rate is lower than your actual expense, why wouldn't you want to take actual expense?
So I can declare my mileage from my house to here.
Mm-hmm.
Can I declare it from here to my house?
Well, when you said from your house, is your house your primary place of business?
That's
'Cause
also my primary place of business. Got a little office, got a little desk, got a little computer.
Okay.
Send out my invoices.
So
from
that
there.
is right. So that is your primary station. Then yes, right. Now
That's big. That's huge.
Mm-hmm.
Did you guys know that? Because I didn't know that. I haven't been declaring my mileage.
well, now you know. Keep track of it though. You want a mileage log, because if you ever get audited, you want to pull it up for the auditor. Hey, this is what we've been doing, is tracking it down here, and these are the receipts. It's hard evidence. So that meets substantiation. It's a mileage log. Now, if you don't have it, she's going to throw you out the door and you can kiss those mileage goodbye. But
Now, is this log some formatted form that needs to be filled out?
there's not a specific format. It does need a date, it does need location, it does need start mileage, stop mileage. But there's not a particular format for it. So, I mean, this could be done on a piece of paper or Excel, or it could even be done on a sticky note.
And if they haven't been doing it, they can start now. Well, for 2025. Starting in January,
now is
people-
better than never, right?
That's right. And
So-
what's the standard deduction per mile? What is that?
I believe it was 56 cents, if I recall.
56 cents.
Although they're changing it, I'm not sure what that rate is off the top of my head.
Think about this, people. That's
It's
$1
either
every
56
2
or
miles.
60.
That's
So-
let's round off so I
Somewhere
can do
in
math in my head. Let's say 50 cents. That's $1 every 2 miles. that you can take off your taxes. $1 every 2 miles I could take off my taxes.
Mm-hmm.
So let's see. So that's so that's $4 just to come here and talk to you.
Yeah.
I could take off my taxes.
Yeah.
Because it's 2 miles from my house.
Now, what you don't want to do, let's say your actual expense. What is your actual expense? Your repairs, your maintenance, licensing. If all that comes out to more than your mileage, take the actual expense.
So would
So in cases of where you have a major repair, I had to get my I need my axle repaired. It cost me $2,000.
I had to get 4 new tires to pass inspection.
Mm-hmm.
So you're telling me that when I do that, and if I take actual over standard, that those 4 tires are deductible?
Yes.
And have you bought tires lately?
I mean,
oh my God.
I did buy tires actually, $2,900.
Oh my God.
$2,900 for
I missed the boat. I should have opened up a tire store.
Mm-hmm.
I almost had a heart attack when they told me how much it was.
Yeah.
I said I wanted the cheap tires. Those are the cheap tires.
I didn't go that cheap. I went with some thick, I wanted some good tread. Get me 5 years down the road.
I settled for Bridgestone.
Bridgestone's good.
Yeah, because I put a lot of miles on the car.
Yeah.
Just traveling around Texas doing my veteran service stuff.
Yeah.
I put a lot of miles on the car.
Yeah.
So tires I don't skimp on.
Yep. So, I mean, absolutely. I mean, you need those tires to get from point A to point B. Otherwise, you're not going. You're not going to generate that revenue, and the tax is not going to get paid to the government. So, yes, they allow those to be deducted.
That's outstanding. I did not know that.
Now,
I thought it was just mileage.
Now, if they allow us to deduct that grocery bill, we'll push hard for that. Pushing hard.
Well, we can go off on a tangent there because you can have some bills that are tax deductible. If you take
let me put this. In that case, you take your clients, out for lunch, business meeting, those in certain situations can be deductible. So yes, certain situations with food, yes, but
so
if you're eating Pizza Hut every night,
what I'm hearing is, my wife goes grocery shopping.
Mm-hmm.
She cooks that stuff up. She prepares the meal. We sit down together because she's an employee of my business, and we discuss stuff.
Is this Thanksgiving?
Could I do that for Thanksgiving? I have 14 people over. We get work.
I mean, if it's a business meeting, if you're discussing business or you're trying to bring on a new client and you want them to come over, relationships are important. They're more important than what even the government realizes, I'm sure. But those in business, in public business, know that relationships with your clients matter.
I have a client that I picked up in 94, I want to say. 94. Hey, how you doing out there? I'm talking about you, right? From one of my businesses, True Consulting. And he is still with me. He is still with me all these years.
That's a long time.
It's in business, it's not just 8 minutes. In business, it's not just taking a person's money, providing a service for them. It's a relationship. Right. And if you build that relationship, you can have clients that'll last forever.
Absolutely.
We still have a lot of stuff to cover, but we're running out of time because I have to do a closing. But I'm going to put this PDF up on the notes section if you're looking at Facebook or YouTube Live or wherever you happen to see us. But real quick, I want to talk about those that are not in business. What about retired people? Anything retired people?
Retirement, I do have something there for you. Now, retirement, they change it every year. Now in 2024, okay, you can contribute this year up to $23,000. Now, if you're over the age of 50, $7,500 gets added to that. Now that gives you a grand total of $30,500 that you can stack away. So,
Tanya, are you listening?
those plans are important. Retirement's important. You don't want to be working forever. You want to enjoy some time, maybe with the kids, your grandkids. So, that's an important thing to do. Of course, I don't advise that. I never advise that you stick all your eggs in one basket. But if you have the money to stash away for retirement, absolutely do so.
Yes, I'm sending you Tanya again this year, your favorite client.
Oh, yeah, I love her. I got to reach out to her, actually.
She's great if you can get her on the phone.
Mm-hmm. Yeah.
She's great if you can get her on the phone. What about people on Social Security? Is there anything for them that they need to know this year?
Social Security, I always get this question of whether or not Social Security is taxable. And the answer is yes, it is taxable. But there's a specific formula that you have to do to figure out whether or not if the Social Security that you got, along with the other income that you received, is taxable. And I've put that form in here in this PDF. So you can click on it. It's the Form 703. And it has the formula where you can figure out whether or not if it's taxable and what you need to be doing. Okay.
See, that's why I'm sending you Tanya, because she's 62 and she wants to go on Social Security. But she has all that big Air Force retirement money. Mm-hmm. And I'm trying to explain to her that may or may not be a good idea, because right now your retirement isn't taxable. But you combine your retirement with your Social Security, you might be over that magic number, and guess what? You're going to be paying.
Yeah, in that situation, just to note, regular retirement from the military is taxable. VA disability is not, so that gets excluded. But yeah, a lot of good things in this document. So
and this will be up. It will be up on the podcasts. Because we go Facebook and YouTube and yada yada yada. Mm-hmm. I'll put this on the website and put a link to it so people can download it along with your information, so they can give you a call and go, Doug said to call you. So, is it too early to start your taxes?
It is too early. I mean, the IRS doesn't open up to at least to the end of, in the beginning of February. So they haven't, I don't believe, posted the date when they're going to open it up just yet. But a good thing to start doing now is, if you have a business, start getting your substantiation documents together. Figure out what your income is, what your expenses are. That way your accountant's not going to be asking at the 24th hour, what are they? So that's a good thing to start doing now, along with gathering what forms that you may need. Ask your advisor. And looking at tax planning. If you can get in there with your advisors, talk about it. Because right now, 2024 is still an open book. If you get in there at the end of the year and you're able to speak and they're able to save you a little bit of money, then it was worth it. But at the beginning of 2025, that door closes.
Well, let's talk about that for just a minute, because you're more than a CPA.
Right,
So
EA.
Tell us what you can do. What does that EA designation allow you to do?
I'm allowed to work in all 50 states. I'm allowed to represent and fund the IRS and prepare tax returns and represent, solve your problems. So that's what it allows me to do. And it specifically, I solve areas in taxation. So
people, call Stephen. He's a good guy, and he knows what he's talking about, even though he is ex-Air Force. I say that. I say that just for Tanya, because I know it will upset her. I want to thank you for coming on the show, taking your time, especially at the end of a busy day, to talk to us and to advise your fellow veterans of what they should be doing and letting them know things that they think they may know but really don't.
Right. I mean, I'm once again very happy to be here and help others realize what they can be doing more. And this is just the tip of the iceberg. A lot of other things out there that you can do, but it's important that you speak with someone about it.
So people, call Stephen. His number is 844-335-0055. Tell him you listened to the show today and you have questions and need help, because he will help you, all kidding aside. That about wraps it up for this show. We'll be back in February, and February is Valentine's Day, so I'm going to do something special for Valentine's Day. Maybe I'll bring us cupcakes, Dick. Something to cheer us on. I want to leave you, as we end today, I want to leave you with the song by our good friend Sailor Jerry. You can go download it at VeteransAir.us or iTunes. I'm sure it's on a bunch of other places. It's called Hallelujah. It's the veteran version of Hallelujah. And while we're listening to it, let us remember our brothers and sisters in uniform that are standing in harm's way today to protect our freedoms and our liberties. If you are wearing the uniform, or you have worn the uniform, I want to tell you thank you. I want to tell you I'm proud of you. And until next time, stay safe and stay vigilant.
You packed your bags and shut the door. You crossed the sea to fight a war. You didn't know just what would happen to ya. Stepped in the dirt, boots on the ground, and gunfire was the only sound. And to yourself you whispered hallelujah, 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 hallelujah. Every day and every night, you walk the walk, you fight the fight. You never saw the end in sight, now did ya? The days are washing a haze of red, the blood, the mud, too many dead. Your weary soul was crying hallelujah, 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 hallelujah. Too late to help you hear a shot. You know you're in a deadly spot. You never thought the day would come, now did ya? Your brother falls down to the ground. The enemy is all around, and from your lips you scream a hallelujah, 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 hallelujah. You fought the fight till it was done. You have the strength to carry on. You thought it'd be much better back home You try each day, keep pushing through, but the battle